Section 9, Topic 4 of Paper 8 takes us on to short-term debt instruments. Now, short-term debt instruments are traded on the money market, and they consist of securities with maturities of up to 1 year. They're referred to as short-term money market instruments. Now, what we have listed on page 17 are different types of short-term debt instruments. Read through all the detail, but they are interbank lending market, bankers' acceptances, commercial paper, certificates of deposit, and exchange fund bills. Now, the exchange fund bills are issued by the Hong Kong Monetary Authority. As we'll see a little later, notes and bonds have maturities of more than 1 year. Bills up to, but not more than 1 year. You can have a question in paper 8 where they ask you which of the following is a short-term debt instrument. They'll give you 3 long-term and 1 from the list you're looking at, or the other way around. They will ask you which one of the following is a long-term debt instrument, and they'll list 3 short-term instruments. So be aware that these are the short-term instruments and read the detail. Will the detail be examined? Less likely. It's more the fact that they are collectively known as short-term instruments. Now, top of page 18, repurchase agreements, repo agreements. This is between central banks and banks to help with market liquidity. And as you can see there, they're often overnight arrangements. So a Hong Kong bank on the right will receive funds from the Hong Kong Monetary Authority, the quasi-central bank of Hong Kong. And for that money, they sell exchange fund notes. Then literally the next day, the bank repays the money that they received for selling the notes, but they will repay at a higher price because that includes the interest element. By doing that, they're repurchasing the exchange fund notes. That arrangement is known as a repurchase or a repo, a repurchase agreement or a repo, and it exists to relieve short-term shortages of funds in the money market. I would say that's as much as you need to know for the exam, but they can set a question on that. Now, 9.7 looks at the pricing of discounted securities. This is often a numeric question, and you're either going to crack it quickly or you may struggle with it. Let's look at the formula. Now, with the short-term securities, they don't pay a coupon. They are discounted instruments. That is to say that you buy them at, let's say, 90, and then they are repaid on maturity 100. So you paid 90 and you received 100. The extra 10 is your interest. Now, in calculating the present value, the price of such a security, we discount the future value with regard to the interest rate and the outstanding period remaining in the term. Now, the formula there, it may look complex. It is not. Let's just consider what we're looking at. FE is the face value of the instrument, 100, 1,000, 10,000, whatever is given in the question. And then you divide that by 1 plus, and you take the interest rate, the yield that's quoted R, but you will reflect the number of days remaining. So multiplied by n number of days to maturity, divided by 365, that is standard. Okay, if you're not comfortable with this, but you want to give a question a good run, memorize that formula, then just as the exam starts on the scrap piece of paper, write it down quickly so that if and when the question comes, you can plug in the numbers. Let's look at an example. Bottom of page 18, a 90-day banker's acceptance has a face value of 100,000 with an interest rate of 5%. What is the current fair market price? Well, it's a case of plugging the numbers into the formula that we've just reviewed. We take 100,000, we put it on the numerator, and we divide that by 1 plus the interest rate which was given to us, the annual interest rate, which was given to us of 5%, and we multiply that by the outstanding days to maturity, 90, divided by 365. So effectively, we're taking a quarter of the interest rate, 0.05. We're estimating the interest rate for the 90-day period. So that gives you 100,000 divided by 1.0123, and the answer is 98,785. In other words, you would pay 98,785 for a banker's acceptance with 90 days to maturity, giving interest of 5%. Now, what they can do in the exam, which is slightly nasty, is they give you the future value, they give the face value of the instrument, they give you the current price, and they give you the number of days to maturity. And the question asks you, what is the yield or the interest rate of this instrument? And it will be the annual rate. And what that entails is calculating R in the formula. So there's two ways of doing it. You plug in all the numbers into the formula you can see on page 18, and you're left with R. And then you have to use simple algebra to isolate R, do the calculation, and you get the answer. Some candidates are slightly uncomfortable with performing simple algebra. So another way around it is to write out the formula with the numbers in, except R, and then plug in each of the 4 answers provided as R to see if it comes out to be the price that is quoted in the question. Now, it will be one question if they examine that, and they have done. That is a regular exam question. Moving on to long-term debt securities. Different types of bonds. Now, bonds are long-term. Bonds are securitized debt. It is borrowing from the markets. Different bonds that we're given here, government bonds. In Hong Kong, we have the exchange fund notes, and they are now 2-year tenors, so maturities of 2 years, and government bonds, which came in 2015, and their maturities are 3 years and above. So in Hong Kong, we've got exchange fund bills, short-term instruments, exchange fund notes, what you would call medium-term, but certainly not short-term, 2-year maturities, and the government bonds, 3 years or more. Other long-term debt securities, supranational bonds issued by multilateral agencies, corporate bonds, that's corporations borrowing from the markets, mortgage-backed securities, which are underlying mortgages packaged by an intermediary and then sold, and the one we have now in Hong Kong is the Hong Kong Mortgage Corporation. We have the renminbi debt market in Hong Kong. Issuers of renminbi debt include sovereigns, mainland banks, etc. Mutual debt market. Now, the example we now have is the Bond Connect, and that enables investors in Hong Kong to invest through the northbound trading link, giving access to the China interbank bond market. Be aware again of the different categories. The classic question is, which of the following is long-term debt? And they'll throw in 3 short-term debt examples and 1 long-term debt, and it will come from that list. Now, 10.2 bond pricing. This can be quite complex, very mathematical. There'll be something from page 20 in the exam, that's for sure. The expected yield. Expected yield of a bond is the return that you are going to receive that will reflect the coupon, the price, and the maturity. So it's the overall return, and it will be a function of market interest rates. The coupon is the interest paid by a particular bond, and that will be a percentage of the face value. Now, that is not necessarily the yield. as I said, the yield's a function of the price, the coupon, and the maturity. The coupon is purely a function of the coupon rate and the face value of the bond. Now, that coupon can be annual, semi-annual, quarterly, or monthly. Now, the relationships in 10.2.3 on quoted prices are very important and are worth one question to you if they examine it. Because a par value bond is priced at face value, let's say $10,000. Now that's known as a par value bond. That is where the coupon is equal to the yield. Let's say they're both 5%. So where the coupon is equal to the yield, it's a par value bond priced at face value. That can be the answer to a question. A discount bond is where the coupon is less than the yield and it's priced at below face value. So a discount bond is where the coupon is below the yield and it's priced below face value. Thirdly, a premium bond is priced above face value, and that is where the coupon is greater than the yield. Now, the way to think about this is, okay, you get a coupon on a bond. If the coupon is greater than the current interest rate in the market, that's attractive. So you will pay more for it. You will pay more than the face value. You'll pay above par value. But if the coupon is less than the interest rate in the market, the yield, that's not so attractive. So you're not going to pay as much. You're going to pay less. That is the way to think about it. Those relationships are worth a question. Now, accrued interest. When you are holding a bond, it will be accruing interest. It only pays interest, let's say, every 6 months. So after 3 months, it's accrued 3 months worth of interest. If a bond is sold before the coupon date, then the buyer is expected to pay that accrued interest. And the accrued interest, while usually reflected in the bond market price, the price can be expressed without the interest. And when that happens, we're on to 10.2.5, we refer to it as the clean price. So the clean price of a bond excludes accrued interest, but the accrued interest is in there. We refer to it as the dirty price of the bond. Now, calculating bond prices, very mathematical. And yeah, you could get a question, not every exam, but they could throw one in. Let's look at the overall concept first. When you buy a bond, you're buying a series of future cash flows. You will be buying the coupons and the redemption value, the maturity, the value that's paid on maturity. And we're referring to that as principal. So in the worked example at the bottom page 20, we see that with a 10% coupon bond of $100 face value, you will receive $10 year one, $10 year two, $10 year three, and the 100 principal year three also. Now, what we do is we discount back each of those cash flows to today's present value. Now, the discount factors that are listed there are calculated by taking the cash flow and divided by 1 plus the yield raised to the number of periods. And that is what you can see in the horizontal representation. So P equals the 10 discounted at 8% for one period, then plus 10 discounted 8% for 2 periods, so we square it, 10 discounted for 3 periods, and then 100 discounted for 3 periods. So we arrive at the present values. That is what these future cash flows are worth in today's value. 9.26, 8.57, 7.94, 79.4, and because they're all in present value, we add them up, and that is what you're willing to pay for the bond, 105.17. Now, we see that the yield is 8%. We see that the coupon is 10%. The coupon 10% is greater than the yield of 8%. And so it must be a premium bond. Indeed it is priced at above face value, 105.17. Moving on to the last part of bond pricing, the risk-free rate. Now, a risk-free asset gives us the risk-free rate. Traditionally, US Treasury notes and bonds would be the sort of global risk-free asset. Return of an asset over the risk-free rate is known as the risk premium. So this is a very general financial theory. The required rate of return of a bond, of a security, of any investment is the risk-free rate plus the risk premium. What is the risk premium? That's where a lot of financial theory comes into play, and we'll be dealing with that later.